Alrighty, so in today's video, I'm going to take you step by step through how to approach the New York AIM session using ICT's concepts. So the first thing I like to do, just to make it nice and simple, I like to look at what London session has done. Where are the swing highs and swing lows? And are there equal highs or equal lows that could be a draw on liquidity, right? That's the first thing. Now, London session or London open session is marked right here, right? And what I'm going to do, I'm just going to draw a text box inside here. That here is London open session plus 30 minutes. So London open is from 2 o'clock to 5 o'clock. And usually I just extend that a little bit more. And that gives me swing highs and swing lows that may be a draw on liquidity. Now, automatically, I can see that this London session high has been taken out, but these London session lows have been left. And notice how these three lows marked in red, they're relatively equal. A lot of liquidity rests there, or you could think of that as like a magnet, because all the retail traders see that as support. So their stop losses are going to be placed below these lows. So the first thing I do is I look at London session, right? So if you're going to take notes or write things down, London session and how it's performed is the very first thing that I do. The second, I look back in the chart. I'm only on the 1 minute time frame, and I just have a look at what the market could also target, right? Now, if these equal lows are my ultimate draw on liquidity, the market may not go there straight away. It may go up to then go down, if that makes sense. And you may have heard ICT talking about this. It's essentially like a fake move to then trick people to go long, and then the market really goes to where it wants to go later on. So what I'd be doing personally is I'd be marking out this swing high, because these two relative equal highs already got taken as well. That is the only close by swing high that the market could reach for. And what I do is I go back to the 15 minute and see on the 15 minute time frame, unless we go back like multiple days, we've already taken out all the other swing highs. So this would be the only major buy side liquidity or external buy side liquidity that the market could be reaching for. So what I'd do is I'd mark that out. I'd get rid of this. And now I'll be watching to see what price wants to do. In my head, I think this is going to be the draw on liquidity, but I'm waiting for time to be in my favor. And what I like to do, even before the market's printed there, I like to actually mark out the macro from 950 to 1010, because if you watch my other videos, the macro is where the price algorithmically will do something important. So I'm watching to see what price does during that macro, and I'm also watching to see what price does at market open. Now, notice on the 1 minute time frame, between this low and this high, there's nothing really major or important there, but go back to the 15 minute time frame. We are sitting currently in a 15 minute bullish gap. Now, this is where you start to, in your head, you start to paint a narrative, because we've been bullish for so long. Like, we're making higher highs, higher highs, higher highs this whole month, right? So it's natural to believe or to think that at market open, when a lot of, I guess at 9:30, a lot of volume and volatility comes in, that price may want to use this and bounce up to take out this high. Now, we don't know that yet, because the market hasn't actually played out. But if it does do that, then our draw on liquidity would be these equal lows. If we break through this fair value gap with displacement, then I'll treat this as an inversion fair value gap, and I'll look to go short, targeting these relative equal lows regardless, right? So you got to let the market show its hand, and you can have an idea formulated before, but often I like to see what market open does, and roughly from 9:30 to 9:50, and it tells me a bit more about what price wants to do. So I'm going to change this to 3 times speed, and let's just watch what price does. Currently, it's 9:28. The market opens. Now, look at that abrupt movement here. I think that's a market open right there. Yeah, 9:30. Notice we sweep this liquidity, right? In my head, I'd now be waiting for this macro period. I've satisfied what I need to see. So I check out what happens in London session. I look on the 15 minute chart just to see if there's any fair value gaps, swing highs or swing lows that price may want to react off. So that's the second thing I do. So just 2 things so far. Then I'm looking for a rate of liquidity. And we've got the rate of liquidity. Now, in terms of which high that high was generated, you could say Tuesday PM session, the previous day, right? So it's been ranging in this price action right here, and then eventually we actually take that out abruptly. Now, what you'd want to see is for this macro to either raid more liquidity or to create some kind of market structure shift. So let's see what price does during this macro, right? And let's kind of slow this down a little bit. So I'll be waiting, I'll be watching price. My eyes at this point would go to this swing high, right? And also would go to this swing low, right? Where do we reach for first, right? What do we break past and then immediately reject off first? So I'll be watching price here. And if you're watching price at the moment, you might be like, oh, price is going to go down, but watch what happens during this macro period, right? It's very interesting what happens during this macro period here. So macro starts 950. We get extremely close to this other swing low here. So again, I would label this as relative equal lows. This low and this low. So price is, I guess, painting a picture for me now that we're going to go down, but now I've got to figure out a way to actually execute the trade. We're in the macro time period too, which is where something important should happen, right? So I'm watching price, and have a look at what price does here. Now, I'm going to play a couple more candles just so you can kind of see. Notice how one candle takes out this swing high, so you raid that liquidity. The next candle immediately rejects. So if you're getting confused between a raid of liquidity or like a continuation, if that makes sense, look at how price trades past it. Does it trade past it? If price were to accelerate past here and then come back down and then move up a little bit higher, it's not ready to go down yet, but look at this reaction during this macro period between these two red lines, right? So the macro is the next thing that I'm looking at, right? The macro is the next thing that I'm looking at. So if I was to summarize it so far, I have a look at what London session's done. I'll have a look for swing highs and swing lows during London session and wait for one of those to get taken out. Then I'll go to the 15-minute chart. I'll look at the overall order flow, right? I'll look for any swing lows or swing highs or fair value gaps that price could react from, because we know that the market only targets swing highs and swing lows and imbalances. And then I'll wait for time. And that's probably the most important thing. None of this matters really, right, in terms of probability if you're not waiting for time. And I've done the back testing myself. I've had a look myself. Time is like the most important thing out of all this. Like, you could just stay on the 1 minute chart and have no daily bias and use this macro and the silver bullet and wait for a rate of London session highs and then enter off the first fair value gap, for example, to the downside, and you'd probably still be profitable, right? You might not win a high percentage of trades, but if you're going for a 1 to 2 risk to reward, you'll still be profitable. And then when you match time with all this other analysis, the probability increases. So time is like the real most important thing. And that's like the key to any, I guess, ICT based strategy. But what we're looking at here is this bullish gap, right? I'm looking at this bullish gap because if we're going to move higher, we should find support here, and the bodies of these candles should not close below that. As soon as the bodies of the candles close below that, I automatically think that this could become an inversion fair value gap. So let's have a look what happens. Right at this point, if I just go back one candle right there, if you're using inversion fair value gaps, that could be an entry model that you use. A lot of people like to execute straight away as soon as price closes past that gap, because price may not always return to that gap. So you could do something like this, right? This is like an inversion model, and you'd be targeting at minimum those relative equal lows. The risk to reward is not that great, but remember, this is our ultimate target. So you could have maybe take some partials off here, more partials here, and then hold a runner to these relative equal lows. They're just too clean. And what that's called, it's called low resistance liquidity. And you'll see how price actually moves when there's low resistance liquidity. Now, if you have access to a smaller time frame, this is where it comes in handy, right? So if I move to the 30-second time frame now, notice how I've actually missed a potential entry here. But what this actually tells me is that we've rated liquidity, we've breached this low, so there's your market structure shift. We've respected this bearish fair value gap already. So if you miss this opportunity, right, now would be the time to enter, because look what happens to price, right? It really just sells off, dramatically just sells off. So if you didn't take this first entry on the 30-second time frame, your next entry would have to come as soon as a candle closes past this inversion fair value gap. And the fact that price doesn't come back up and return says to us or to you that price is extremely bearish, right? We've got these two relative equal lows here that the price wants to target. This one here and this one here. Plus, we've got these three relative equal lows down here that we targeted before and we mentioned before. And that's from the London session, right? Plus a little bit after that, the London Open. So if you don't have access to the 30-second time frame, this is where having an understanding of other ICT PD arrays can be very beneficial, right? Because at this point, we're already in the silver bullet hour, and you might go to the 2-minute time frame and say, okay, I'm going to enter when price returns back to this gap. I'm going to enter when price returns here. So you might set a limit order for the start of that gap, stop loss maybe above this high, and then you're targeting, those relative equal lows, whatever you want to do, right? But look what price does not give you an opportunity to actually execute. So having an understanding of other ICT PD arrays really do help, right? It really does help. I started just with fair value gaps, and I started just with a 1-minute time frame, and this would happen to me quite a bit. So in terms of this, the macro, notice how important that macro is. And this is like a really good example. The macro here does important things. It raises liquidity, and it also has a market structure shift. Now, 30-second time frame says it all, but if you don't have access to that, you'd be using that inversion fair value gap to go short. Now, personally, I don't really like using just one PD array, right? So if I was going to enter off an inversion, I like to see that this bearish gap has already been respected, and now we're closing below this inversion on the 1 minute. So that's my first signature after we rated liquidity. And then on the 1 minute time frame, you could enter straight away once that candle closes. That will be more confluence than not seeing that 30-second time frame and not seeing how prices actually reacted there. So what you notice is that this massive green candle here, when price closes below with this candle, that indicates a change in the state of delivery. And you might have heard that term, right? A change in the state of delivery just means that it's changing from bullish to bearish or bearish to bullish. And the way you know that, I guess, is by the fact that this is a really big green candle. It's an order block, right? So the fact that we're actually breaking past that now, breaking past this massive green candle, indicates that the price, this green candle isn't actually supporting price to go higher, and instead people, or sellers, as you would call them, are coming into the market. So we break past change in the state of delivery. We respect this bearish gap. These three up close candles also represent an order block, right? We break past that, another change in the state of delivery, right? So it's been solidified. We spend a little bit of time here in this inversion gap, and I just want to illustrate that as well on the 15-second or even on like a 10-second chart, just so you can kind of see what I mean. Notice how we spend a little bit of time here. That orange box is the inversion fair value gap. So we come up into this SIBI, we come back down, we spend a little bit of time here, and then we immediately just place to the downside. And here's the thing. If you always wait for silver bullet, you may not get the entry you want. If you always wait for the 1 minute time frame, you may not always get the entry you want. So diversifying, I guess, the field I've found to be really beneficial for me, and I'd recommend trying it out yourself. So this is a really nice entry model. Notice what price does. It actually takes out these relative equal lows. And how quickly it takes it out is called a low resistance liquidity run, because of the fact that there's relative equal lows. And it illustrates the point perfectly, right? So these things here, this is what I look for if I'm trading New York session. I start off, and we'll just do a bit of a summary. I start off looking at London session, and what I look for is any swing highs or swing lows, and I might just mark that out. So I look for swing highs, swing lows, equal lows, equal highs, right? All I'm looking for is liquidity, right? That's all I'm looking for in the London session. And I know that the London session is important if you're trading the New York session. Now, if you're trading the London session, you'll be looking at Asian session highs, Asian session lows. Same principle here, right? Exactly the same principle. All these 4 steps will still apply. 15-minute chart, I'll look at the 15-minute chart to see fair value gaps, swing highs, swing lows, and also the overall order flow of price. Right now, since we're trading on the 1 minute time frame or the 30-second time frame, it could be classed as scalping. So even though the overall order flow is bullish, as we saw in the 15-minute, I can still take short trades, and that's completely okay. Rated liquidity, and I'm going to actually just get rid of this. I'm also just going to make this number 3. I'm just going to simplify it into 3 simple steps. So I see what's happening in London session. I look on the 15-minute chart, and I look in terms of the macro, and I look for rated liquidity, market structure shift, or something important to happen. And in this case, it's a great example. We get all of them. All things happen. We get a rate of liquidity here. We get a market structure shift. We get a change in the state of delivery. Everything here is telling me, right, just in this small section, that price wants to head lower. Every single thing is telling me that price wants to head lower. And again, we talked about we could use an inversion fair value gap on the 1 minute time frame. If you wanted to execute on the 30-second, you could have executed off this SIBI, or you could have waited for that to hold and then executed straight away as soon as price closes below this inversion fair value gap. So this is another way to read price, but generally speaking, right, it's a really, really good way to approach the markets. Having, a set of rules, whether it's 3 rules, 4 rules, 5 rules, really helps me approach the markets. And for me, the trickiest thing isn't how to enter, it's having an understanding of where price wants to go and allowing the market to tell you where it wants to go with the highest probability, right? Because we're not going to get things right 100% of the time. I'd love to, you'd love to, but it's not going to happen. So for me, I like to wait for the market to tell me what it wants to do, use time in your favor, and then apply higher time frame PDRAs and understandings to the market, and general liquidity principles to the market as well, right? So I hope that kind of helps. If you've got any questions, feel free to leave in the comments below. But this is the second video of my approach and how I approach the markets during the New York session.